Good evening, everyone. Welcome, welcome, welcome. We are so excited to see so many people already logged in tonight. Welcome to our newest and our latest workshop. Tonight, we are going to be talking about how to compare your mortgage loan options, something that is so incredibly important as a home buyer. When you're getting pre-qualified for a mortgage, there's so many fantastic options that are out there. If you're working with one of our homeownership counselors at Dallas Habitat, you know that, right? We've referred you to partner loan officers who have some fantastic products. But really what it boils down to is understanding what product is best for you. And that will absolutely vary home buyer to home buyer. So we're so excited tonight to dig into this topic with some of our fantastic partners. Before we do that, just a few housekeeping rules. If you haven't been to one of our webinars, welcome. We're so excited to have you. As a reminder, Dallas Habitat hosts these live webinars on all different financial education and homebuyer education subjects 2 to 3 times a month live. And you can also find these webinars on demand by visiting our website. So if you're brand new tonight and you see classes on our calendar that you wish you could have made or wish you would have known about, make sure you go back. You can absolutely access those on demand at a later time. You'll also be able to access tonight's workshop in the future if you need something to pull back on. So make sure that you are taking full advantage of those resources. My name is Blaine Cower. I have the great and tremendous pleasure of leading the homeowner services team here at Dallas Area Habitat. My team and I are so proud to offer a fantastic homeownership counseling and education program. And tonight's workshop is just a sneak peek of that. Give us a shout in the chat box. I want to know if you're working with one of our counselors, let us know in the chat. We'd love to hear from you. So without further ado, we just want to remind you, in terms of communicating with us tonight, this is a webinar format, which means you don't have microphone access, but we still want to hear from you. We want to make sure that you get all of your questions answered. We want this to be engaging and informative and fun for you. So make sure that you send us all of your questions in the chat box, and myself and our co-host this evening will make sure we get through as many of those questions in detail as we can in the time allotted. So with that said, I'd love to introduce you to our guest speaker tonight. Alex Islas is with us from East West Bank, a partner of Dallas Habitat, and we are so excited to have him here for his first workshop. Welcome, Alex.
Thank you for having me and having us, and I look forward to providing some insightful information that can help as many folks out there understand the process that sometimes appears to be complicated and difficult. So hopefully we can provide some clarity tonight.
That sounds awesome. Feel free to take it away.
Well, I appreciate every single one of you guys being on tonight. Part of the home buying process, and by the way, let me introduce myself. I kind of jumped right into it tonight. My name is Alex Islas. I am the Community Outreach Officer for East West Bank. And my role is to provide education and assistance for our partners and low to moderate income individuals throughout all the areas that we operate. So again, once again, I'm happy to be on. So I think we could probably go on to the next slide. Okay. So before I kind of get into that, I started with the home buying process begins even before you start looking for a home, before you've even been pre-approved, before you met with your counselor. It really starts in seminars like this, where you're gonna reach out and learn, whether it be lingo, whether it be specific definitions of what they mean. It's the education that it is really gonna be beneficial for you guys, not only while you're going through the process of buying a home, but once you've bought it, right? It's once you get your first mortgage statement, you're gonna say, now I remember what this meant. I remember what this was, right? You know, even now, right, we're gonna compare or try to give you some information about different products, it's key. That way you can understand where you fit in, right? And what I mean by where you fit in is each of you that's on this webinar tonight, you have different situations, different incomes, different credit scores, different amounts of money in the bank, different goals, different types of properties. Everything is different about each other. So the key is for you guys to learn some basic information so you can start understanding why maybe a specific lender is suggesting a loan, or maybe you don't agree. Based on the basic information that you've learned, it's going to allow you to ask the right questions and really, ask, why am I being put into that? I thought this was for this versus that. So it's going to give you some more ammunition to ask the right questions. So let's start with we're going to first cover some basic terms, okay? So principal, and I wish you guys really had microphone access so I can kind of ask you these questions. But so what is principal? Principal will always refer to what's most important to you, which is the amount that you owe, right? So when you're making a payment on your mortgage, or we're talking about the principal loan amount, we're talking about the amount that you owe. So when you're making your payment, what is being deducted from your balance is your principal. Your interest and your interest rate. So your mortgage payment is going to be made up of your principal and your interest. The interest is the portion that's the bank's profit, right? And that is dictated by the rate the interest rate that you obtain. Now, your annual percentage rate. This one tends to get a little bit tricky, or the definition, but it's really your interest rate plus all of the fees that you are paying for on the loan. So if your interest rate on if the interest rate that dictates your payment is 4%, but your APR is 4.9, that means that there's 0.9 fees being financed into your rate, into your loan. Loan to value. That's basically the amount of down payment that you are putting. So if you're buying a home for 100,000 and you're putting 0% down, your loan to value would be 100, right? If you're buying 100,000 and you are putting down 3%, right, then your loan to value would be 97. So basically, that's the sorry about that. I got to put mute here. People are trying to reach out to me. So that's the loan to value. That represents how much you owe versus the value of your home in percentage. Amortization is the length of time that your payments are spread over. So typically on a mortgage, your mortgage is going to be between 15, 20, or 30 years. Equity. That is the difference between the value of your home and what you owe. So anything in between is your equity. So again, what you owe versus what the home is worth, that chunk in between, that would be your equity that you've accrued or that you have in the home. So we're going to get into types of mortgages. And I'll try and explain kind of each of them. But these are kind of, this goes in line with the loan programs, the different loan programs. So for example, first, conventional. A conventional loan is a loan that most banks will offer. So your big brand banks, B of A, Chase, the larger banks, that's typically a loan that you can get pretty much anywhere. That loan typically is going to be slightly cheaper to obtain. Um, Also, the credit score requirements may be a little bit stricter, and you're not able to obtain as much assistance with your closing costs with that type of loan. So that type of loan is typically reserved for, not reserved, but typically the better option for higher credit scores, don't need much assistance with closing cost, and pretty much just a more straightforward borrower. FHA. FHA stands for Federal Housing Administration. The government does not give out loans, but what FHA does, it insures them. And basically what that does is it motivates lenders and banks to be a little bit more flexible in regards to the requirements. So as the conventional loan, it's a little bit stricter. FHA tends to be a little bit more flexible in regards to providing assistance with closing costs, being more flexible when it comes to credit requirements, being more flexible with credit, income, assets requirements. VA, it's a veteran administration loan. That would be a loan if you've served in the military or serving in the military. That is a loan that is reserved for you. That's a great loan, provides a lot of benefits. Some of them are no down payment, no mortgage insurance. So that's a great option for veterans or active military members. USDA loan, that is a loan if you're thinking of purchasing a home somewhere rural that qualify and the property qualifies and is in the designated areas for a USDA loan. Again, that's a great option. It does have zero down payment, as low as zero down payment options. Very flexible as well. So that's an option for folks that are looking to purchase in those areas. Now, we talked about briefly conventional, FHA, first-time buyer programs. So when someone says, I'm a first-time buyer, I want a first-time home buyer program. What that's referencing is that you could not have owned a home in the last 3 years. So by definition, not having owned a property in the last 3 years, that is what makes you a first-time home buyer. Now, the benefits of obtaining a first-time home buyer program, depending on the financial institution, you may come across flexibility in regards to income, employment, down payment, amount of reserves. So the requirements they're typically going to be slightly lower and more flexible, simply because you're a first-time home buyer. So the banking institution is going to understand that you may not have the strength of somebody who's bought, 3, 4, 5 different homes. Now, a portfolio loan. Typically, a portfolio loan is going to be a conventional loan, but it's coming directly from the funds that the bank is providing it. So, for example, a conventional or an FHA loan, right? That's a loan that's being insured by the Federal Housing Administration. A conventional loan typically is going to be a loan that is insured by either Fannie Mae or Freddie Mac, right? A portfolio loan typically is not going to have any type of backing. The backing is going to come from the institution that's offering that financing or the loan, which means that the one that gets to set the guidelines is the bank offering it. With mostly all the other loans, the guidelines are not set by the actual lender. They're typically going to be set by the entity that is insuring the loan. So that's a bit different. So that allows you for potential increased flexibility with a portfolio loan. Well, now let's talk about some other terms here. Fixed rate versus an adjustable rate mortgage. Fixed rate is exactly what it sounds. It's a rate that's fixed for a specific set of years, and it's not going to change. An adjustable rate mortgage, again, it's exactly what it sounds. It's going to adjust. It can go up, it can go down. There's going to be different factors that lead into that, but those are the two types of rates that you're typically going to be offered. Subprime. Subprime is, you have prime and then you have subprime, right? So basically that's referring to loans that are being offered to individuals who haven't met a specific credit score, specific down payment requirement, specific asset requirement. So if they haven't met the requirements to obtain a prime loan, then you're going to get a subprime loan. So typically those loans are going to, be available at slightly higher rates, more expensive, and terms that are probably not as advantageous. That's why it's extremely important to really think about, is your goal, do you want to get a home at the moment? But you also have to take a look at the terms that you're being put into, versus, going through counseling, working with your counselor, and putting yourself in a situation where you don't need a subprime loan to get into that home. And again, those are all questions as the home buyer, you're going to have to kind of really learn and kind of ask yourself, right? Now let's talk about loan cost. Now, so when you're buying a home, one of the things you really have to pay attention to is you get all your paperwork, right? You get your taxes, all of the requirements, and you fax them in, or you go to the office, whoever's going to handle your loan, you sit down with them and you provide them all of your documentation they're going to review. And then they say, congratulations, Mr. Islas, you've been pre-approved for a $400,000 loan purchase price, and your down payment is 3%, right? So 3% of 400,000 is 12,000. That's your down payment, right? That's not your total closing. That's not the total amount of money you need to have. That just covers your down payment. And the down payment is, if you're buying a home for 400 minus 12,000, you're going to get a loan from the bank for 388,000. So that down payment goes directly to the balance of the purchase. That's what your down payment is. Now, this is the second portion of your closing costs. So you're going to have your cash to close, right? On the left, we have your down payment. On the right, we have your closing cost. And typically your closing costs are going to be about 2% of the purchase price. And I'm keeping it general. If you're getting down payment, I mean, if you're getting grants or assistance, or all of that, it could potentially cover that. But for this example, you have your down payment for 3%. You have your closing costs for 2%. So if you're buying a $400,000 home, you should expect to need about $20,000. Now, 2%, some may think it's a little steep. Maybe it's not enough. I just use that as a just the average. Now, reserves, right? So you have your down payment. We have our closing cost. We have enough money to close, right? We have enough money. We're good. But depending on your loan, right? Your loan program, whether it's a conventional, right? Or it's an FHA loan, USDA loan, whichever loan program you decide to go with, you need to ask this question: what reserves am I required to have? Now, what are reserves, right? It's basically money in the bank that you have as reserve, right? It's, you have that in your gas tank. Aside from what you're spending, aside from the down payment and your closing cost, some lenders may require that you have reserves in the bank, and that can vary. It can be 1 month, it can be 2 months, it can be 3 months, it can be 4 months. Now, even if your bank doesn't require it, it's always nice, it's always good just for your own personal budget to have between 3 to 6 months. Now, if you don't have that, that shouldn't prevent you from owning a home, but that might be something worth considering talking to your counselor, right? How do you get there faster? That way, you're not only just doing your portion of the down payment and the closing costs, but you also have some money left in there. So that's what reserves are. Now, escrow is an independent third party that is between you and the seller, right? And they basically handle the exchange of documents, of monies. They make sure that everything is being done correctly, legally. So they're just an independent third party that kind of litigates between the buyers and the sellers. Now, there's a fee that is part of your closing costs.
Hey, Alex, can we talk a little bit too about escrow accounts for managing taxes and insurance?
Yes. So an escrow account, it's a little confusing because most of the time you're being told escrow is an independent third party, right? And what the word escrow is, what it means is it's a independent intermediary between two parties, right? What she was referring to was escrow account. So when you buy your home, typically if you're a first-time home buyer, most lenders are going to require that you include your taxes and your insurance in your mortgage payment. And in order to include your taxes and your insurance into your mortgage payment, the bank has to open or establish something called an escrow account, right? And again, it's very much in the same spirit of escrow in regards to being the middle person between the buyer and the seller. In this case, the escrow account is going to hold your taxes and your insurance. So every month, when you get your bill and you're making your payment, we're going to take the principal, we're going to take the interest, then we're going to take the taxes and the insurance, and it's going to get sent into that independent account that holds your escrow, your taxes and your insurance. That way, when that bill is due, the bank eliminates that debt right for you. Now, to establish that account, depending on what time of the year, the initial deposit that you fund into that account can be as little as 3 months or as high as 9 months of taxes and insurance. So that, again, that's an additional closing cost. Now, you've sat with your loan officer, you've been pre-approved, they've told you about how much money cash to close, your down payment, your closing costs, they told you all this stuff, right? They've explained to you about the escrow account, you submit an offer to purchase a home, and it's accepted, right? In order to officially open escrow, you have to do something called an earnest money deposit, or a lot of people call it an EMD, right? The earnest money deposit, what that does is, it's also known as a good faith deposit. So you're basically saying, not only did they accept your offer, but in order to open escrow, you're making an earnest money deposit. Now you're putting a deposit into escrow to show your commitment to buying that home. Now, that money isn't lost. That money becomes part of your down payment or your closing costs, but typically banks will use it towards your down payment. So if you deposit 1% in earnest money deposit and your required down payment is only 3%, that means you only have to come up with another 2% because you already have one in escrow. And so that's an EMD, that's your earnest money deposit. Points. So points is typically when people refer to points is that's how much you're paying to obtain either the loan, the financing, or a specific rate. And I'm hoping that we finish this one, I don't get another one that says discount points, right? But so you're gonna have 2 points. You're gonna have 2 fees that are defined as points. Points would be typically the origination points. That is how much the lender is charging you to arrange your financing. Or you have discount points, which means is points that you're paying to reduce your specific interest rate. Now, what does points equal, right? It's all based on a percentage of your loan amount. Okay, so you can use either you're going to be charged points for obtaining the loan, or you're going to be charged points for obtaining a specific rate. And typically, you're going to pay in increments of a quarter. So if you're paying 1 point and your loan amount is 300,000, then 1 point would be $3,000.
Hey, Alex, quick question from the audience about earnest money.
Yes.
If we pay earnest money on a transaction and the purchase does not go through, do we get that earnest money deposit back?
Yes and no. And that's a good question. So when your offer is accepted, so just so you know, and I'm not a realtor and I'm not pretending to be one, right? But when you are negotiating the purchase of a home, literally everything is negotiable from the time the inspection is done. So everything in the loan is negotiable, including the earnest money deposit, the amount, and also the timelines that exist in the contract. So when you buy a home, you're entering a legal binding contract, and you have kind of like checkpoints, and you have your appraisal checkpoint or your appraisal contingency, which means that you have a certain amount of time to obtain the appraisal. And once you obtain the appraisal and the value comes in, you basically, once you sign off on your appraisal contingency, you're telling them that you're buying the home at whatever the appraisal value was. If it's higher or if it's lower, you're basically agreeing if you sign off on that contingency. Then after that, you have your loan contingency. At that point, you're basically saying that you've been approved and that you accept the terms of the financing of whoever the mortgage company or bank is. If you sign off on your appraisal, on your loan contingency, then you're basically, that's another road match. So now we're deeper in the forest. If you sign off on all your contingencies, you go past all those roadblocks, and then at the end, you decide you just don't want the home anymore, or something happens, but you have already removed those roadblocks, you can't go back, because we don't have any bridges to go back, because you've knocked every single bridge, because we've gone so deep into the process that now that earnest money deposit can potentially be at risk, because now you've gone so far where now the seller can technically claim that he's been financially damaged, so he could technically keep a percentage of your earnest money deposit. That's why those roadmaps or those roadblocks are so important. When you cross them, you have to make sure that you're 100% sure that you're crossing them, because really what you're doing is you're protecting your earnest money deposit. Now, appraisal. So the appraisal is, you pay for the appraisal. It's part of your closing cost. And basically what that is the bank sends out an appraiser, a third party independent appraiser, and he's going to determine what the value of the home is. And that's done really for protection, for your protection. You, just because you decide you want to buy a home for 400,000, but it's really only worth 300,000, doesn't mean the bank's going to lend you on that value just because because the seller decided that that's the value. So that the appraisal, again, it's an independent opinion of value. Now, PMI, private mortgage insurance. So if you guys remember on the previous slide, um, we talked about FHA not offering, the federal government is not a lender, right? But they do have, mechanisms in place to ensure loans, to motivate lenders and banks to lend to first-time home buyers or individuals who may have less than desirable credit or need a little bit more down payment. What PMI does is that's the insurance that you pay in order to have these lenders lend to you under certain circumstances. So typically that circumstance is in relation to down payment. So if you're buying a home with less than 20% down, you're typically going to have to pay PMI. And what PMI does is it's an insurance that you pay to have the bank lend you while you put less than 20% down. So if you lose the home, that insurance kicks in, it covers the bank. You still lose the home, but it covers the bank. So again, it's kind of a fee that you have to pay to motivate the bank to lend to you. Now, a lot of people think it's a negative. A lot of people think it's a positive. I personally think it's a positive. If PMI didn't exist, there's the potential that maybe a lot of banks wouldn't lend. So again, it's really about getting into the home. Now, before you begin, be sure you understand each phase and what to expect, right? So pre-qualification versus pre-approval. A pre-qualification is my opinion, right? That's really what a pre-qualification is I can literally sit here and talk about finances, how much you make, how much you owe, what do you pay, what's your down payment, all these things. And I could say, you know what? I think that you're going to qualify for X amount. That's typically what a pre-qualification is. It's kind of just us having a conversation. It's really not official. It's really more of an opinion. A pre-approval is we verified, not only have we had that conversation, but we verified the information you provided in that conversation. The bank is still not going to give you a commitment to lend, but we would have verified. You said you make this much, show me your pay stubs. You say you have this much amount of money in the bank, we've checked your bank statements. You said your credit score 750, we've checked your credit score. So it's verifying the information so it's a little bit, it's not a commitment to lend, but it's a thorough reviewed, not a commitment, but it's been thoroughly reviewed. So that's what a pre-approval is in comparison to a pre-qualification. Now, we've gone through the whole process. We received the pre-approval, we got the home, you negotiated, you put your earnest money deposit in escrow, you've done all these things, you got approved, we're gonna lock your rate, right? So now what that means, once we lock your rate, is that gives us a specific window for us to close your loan. So we lock it, and that rate is going to be locked for a specific lock period. So basically, if we lock it for 15 days, that means we got to get the loan done in 15 days. Otherwise, if that rate expires, there's going to be fees to extend it. So that's what that is in relation to. Now, underwriting. So we've gone through the whole process, right? We've looked for the home, negotiated everything, did everything. We got your documentation. We've submitted your loan into processing. Now it's for real, right? Now we're not pre-approving. You got the pre-approval in order for you to go find the home. You found the home, you come back, we put your loan together. We initiate the processing. Then it's going to go into underwriting. What underwriting is that's when the bank's representative will review your taxes, verify your employment, look at your income, look at your pay stubs, calculate your pay stubs. They will thoroughly review your entire financial situation. And you're being underwritten, you're being reviewed, you're being scrutinized, right? Your finances are being scrutinized because you're asking the bank for a 300,000, a 200,000, whatever the amount is, loan. And that's the underwriting part of the loan, which tends to be potentially, maybe in my opinion, maybe the most stressful part, because you really have no control of it. It kind of goes into a cave. We try and everybody's going to try and package it right, with try and foresee what they may ask, but it's kind of thrown into a cave and then it comes out and and hopefully we have good news and everybody's excited, right? Now, the loan comes out of the cave, it got approved, you're good, right? There's some other conditions that the underwriter may want, a letter here, a clarification about this, a verification there. Once all of those conditions have been met, then you or we would initiate, or your lender would initiate the closing process, which is where everything starts to settle down, right? Everything starts to get set, right? It's kind of like the loan process. The best way I can describe it as is kind of like mixing cement, right? It begins with, bags there, water here, just putting it together, kind of messy, right? You go through all these stages, but once you're out of underwriting, once everything's been mixed, closing, everything starts to harden. Everything's taken everything. It took shape. Now you know what it looks like. Now we just set it and let it just harden. So that's kind of that would be the closing process. So let's talk about some documents that you're going to review, or you're going to receive, and things like that. So pre-qualification, again, a pre-qualification or pre-approval letter, that is a document way at the beginning. That's like your first bag of cement, right? You get that, and that's going to allow you to potentially start looking for homes. So you get your pre-qualification letter, and you're also going to get your closing cost worksheet, right? That way you get these in conjunction. That way you know how much you qualified for, but you also know how much it's going to cost you, right? And again, the reason I mentioned is you qualified for 3% down. Okay, well, 3% isn't only what I'm going to be paying for. What's my total closing cost? What's my total cash to close? The closing worksheet will have that outline there. So typically you want to get these two in pair, conjunction. Now your pre-approval letter, remember, your pre-approval is pre-qualification, conversation. Pre-approval is verified conversation, right? So that's what your pre-approval letter is. Typically, your pre-approval letter is going to look a little bit, much more serious, and because the verbiage should provide that that your credit score, that your income, that all these things have been verified. Versus a a pre-qualification typically isn't going to carry that verbiage in there, but that's going to depend from lender to lender. Now your loan estimate. Your loan estimate is, so when you first obtain your pre-approval, it's very similar to the closing cost worksheet, but the reason it's called loan estimate is because this is a more, typically, if you're getting a loan estimate, you would have had your credit ran. We would have received documentation that we reviewed. So your loan estimate is gonna include your proposed terms, right? Your payment, your down payment, your loan amount. It's gonna show your proposed loan. That's not a commitment to lend, but it should be very, very close to what your financing should look like, barring something completely different. Now, 1003 or loan application. The loan application is I make it look a bit dramatic, but I always remind people that the loan application it's an actual financial statement that you're signing to. So a lot of people are going to say the 1003 or the loan app or the loan application, but remember that that is a financial document that you are certifying and you're providing it to the bank. So you need to take that extremely serious, because that information that is put on that application, at the end, you have to sign it. So you can't say, well, I didn't put that there. Your signature goes on it at the end. So take that extremely serious, because you want to know what information's on there. Now, your closing disclosure, that is a document that outlines your terms, the final terms of your loan. It's very similar to the loan estimate. The loan estimate occurs at the beginning. The closing disclosure occurs typically right before closing. These two can't vary much. They can't be completely different. They have to be somewhat similar. That's why you're provided estimates at the beginning, and that's why you're provided the closing disclosure at the end. They should be fairly close to each other. And much of the same information that you received on the loan estimate is going to be on the closing disclosure. Now, the deed, that's your if we get to the point where you're reviewing your deed, you are going to that means you're signing your loan documents. That typically is going to outline the property, the location, you know, the owners, which would be you, the new owners of the property. So that is your deed of trust. That is you know, everybody wants to get to that point where they're actually looking at it, because now that's the document that gets recorded with the county's recorder's office that says this property belongs to this person. Now, before we go, I tried to not use as much loan lingo as possible. One piece of advice is that when you're sitting with the lender, the bank, the escrow officer, the realtor, if there's certain terminology that you don't understand, don't assume you know what they're talking about, right? Or don't be afraid to ask, you know, because again, you know, it's your home, you're the one who's purchasing it, so you should be very clear as to what is it that they're talking about. Now, you know, build a trusted home buying team that can guide and educate you every step of the way. That's super important. Actually, you're going to have two completely vastly different relationships with your lender and your loan officer. I mean, they're the same, but meaning your lender and your realtor. Two completely different relationships, right? The realtor helps you find the home. The lender is going to help you obtain the financing. But everybody's got to be on the same page, right? And have your best interest in mind. And again, if you don't understand something, make sure to ask. Because sometimes I think that it happens to me, right? I go to the mechanic, I want to think I know what he's talking about, but I probably have no clue. I try and Google it. It's, you know, it's just going to confuse me further. So I would always ensure that I ask and make sure that everybody on your team is, including your counselor, because your counselor is part of your team. They all have to kind of, you know, just support you and ensure that they have your goals in mind. See? So any questions, guys? So I appreciate your time. Any questions?
Alex, that was fantastic information. Thank you so much. We just ran through so much critical information in 45 minutes. We've had some really good questions come in so far from the group, but we want to hear from you all. We know that you have questions about this. We want to make sure you get those questions answered from Alex and from our team tonight. So send us your questions in the chat box in the Q&A. A couple of things, we have had a couple of questions come through that I'll pitch to you, Alex. And before we do that, just want to dig into a little bit more on this topic of the importance of comparing your loan options. So just for the audience's point of reference, according to the CFPB, which is the Consumer Financial Protection Bureau, homebuyers can save on average $9,000 over the term of your loan if you shop your loan options and don't just go with the first approval that you get. $9,000, y'all, that's real money, right? So this is the importance of, just like anything else in your life, right? Are you gonna go into a car dealership and go with the first car that you're approved for? Maybe, but probably not, right? So important that we are shopping around and understanding our purchase power. Something that we take really seriously at Dallas Habitat when it comes to homeownership counseling is really helping you as a home buyer understand your purchase power and helping you put your financial profile in a position to be able to maximize your purchase power and really be able to put yourself and your best foot forward in front of lenders, right? And so Alex tonight talked about some of these like really fantastic first-time buyer products that are out there, FHA, conventional, sort of what it takes from a credit perspective, from a down payment perspective. There's a lot of factors. And when you work with a counselor, we're going to help you analyze your financial profile to make sure that you're taking the appropriate steps to be able to get into an affordable product and not a subprime loan product. So Alex, you talked a little bit about the loan estimate and how that's this like universal document, right, that all lenders use, that home buyers can take and sort of compare apples to apples. Can you talk a little bit about like, okay, I've gotten, let's say like 4 or 5 approvals from different lenders. What are some of the most important things that I need to be looking at when I'm comparing across the board?
The most important thing you want to look at is, look guys, most banks, for the most part, most banks, we should be more or less able to offer you more or less about this, not the same, but everybody should be more or less around the ballpark, right? With the exception of special programs or down payment assistance. But the number one thing you want to look at is your APR. That's the first thing I would start, because that is kind of the place you can look at to see where the hidden goodies are, right? Because not all 3% are the same, right? There's 3% with no points, and then there's 3% with a whole bunch of points, right? So when you get your loan estimate, it's going to look like a bunch of ads everywhere because there's just numbers everywhere, right? But the one place you can look at right off the bat is your APR, because that'll show you how much the cost of financing is. And again, if your rate is at 3% and your APR is at 5%, then there's a whole lot of fees in there, right? And then that right off the top, you can have a conversation saying, why is the APR so high, right? My counselor at Habitat told me, right, let them know, told me that, that has to do with fees. Can you please explain that to me? And then right off the bat, it allows you to have a conversation and they have to address it. That's the first place I would look at. Loan estimate. The second place I would look at is your cash to close. So remember, guys, I hope you remember this, right? Closing cost, down payment. So as a general estimate, we said 2% of the purchase price. So if you're being told that you qualify for a home with 3%, 3% plus 2%, that equals 5%. So get your loan amount or your purchase price and say 300 times 5%, that would be 15,000. But if your cash to close isn't more or less around the $15,000 area, it's more like 25,000 or 30,000, then maybe something's off. Something's off, right? So I think those would be the two things that I would kind of start with: APR and cash to close.
Yeah, I absolutely agree. I think that's fantastic. And I think that, cash to close is one of these really underestimated parts of the home buying process. We find in working, especially with first-time buyers, this is our specialty, of course, you know, here at Habitat. And I think that most home buyers are most intimidated by credit. When in fact, what we find is that, you know, lenders actually have more flexibility in credit than you might assume. And the credit score that you think you need for pre-approval is not necessarily what you actually need. However, many first-time buyers walk into the transaction of homeownership or really trying to seek out homeownership with very little money in savings. And Alex,
Right.
to your point, you know, when we talk about even a very, very flexible program with only 3% down, which is about as low as you're going to find, right? Plus 2% closing cost. Plus, you know, we talked about, of course, some of the like your earnest money deposit, reserves, these sorts of things. To our audience, you know, we at Habitat would say this is exactly why you hear our counselors say save, save, save. It is so critically important as a homeowner that you're saving, not just to get into the transaction, but then once you have the keys, that's just the beginning of the journey. Right. And now we're financially responsible for maintaining this house. So saving is so critically important. That closing cost worksheet that you'll get at the beginning in combination with your loan estimate and that outlining of your cash to close is really going to help you get a good idea of how much money realistically you're going to have to come out of pocket for. I wanted to talk a little bit too, when you're comparing your loan options, Alex, what, you know, assuming that you're doing so, like, let's say with a loan estimate, and so therefore your credit has been run, we get this question a lot. How long do you have to be able to shop your loan options before your credit takes another subsequent hit?
You typically want to do it, as a rule of thumb, you want to do it within 30 days. So you want to get those inquiries out the way within those, that way we keep it as a moment in time, right? So, and that applies to you're shopping for a mortgage. All of your inquiries are going to be within a moment in time, right? Within a 30-day period, which that way your credit is it's an algorithm, and it tends to recognize that you're shopping for a home, right? Now, again, we keep it as a moment in time. If you ran your credit, you know, 3 times January, and then you put that to bed, now you're going to start shopping again in February and run it again another 2 times. And now it's a 6-month process that you've been looking at it, but the whole time you've been running your credit. Now it's not a moment in time. Now it's a trend, right? And that algorithm is built in such a way where all of a sudden it starts thinking that something is wrong, because now you're applying for credit and you have aged inquiries in your credit, and that algorithm may begin to assume that you haven't been approved. So now it's those inquiries start dragging down on your credit. So I would say 30 days.
Yes. The moral of the story really is, you know, make sure, and Alex mentioned this earlier, right? Like when you are ready to move forward, you've got to be serious about moving forward. You don't want to just, you know, go out and get some pre-approvals and then say, I don't really think I'm ready, or I don't have my stuff together. Make sure that the timing is right on all of this as well.
And let me add one thing that you mentioned was that saving is so important. And don't assume that your credit score or your income isn't where it needs to be to buy a home. The biggest, in my opinion, 20 years of doing this, the number one thing that really gets in the way, or the number one thing that tends to be the problem solver, is reserves. So it doesn't really matter how much you make. Well, it does, but it really doesn't matter how much you make if you have a whole bunch of debt. But your income could be not ideal. As long as those debts are under control, you're still going to have the ability to maximize your income because you have very little debt. Now, if you, for whatever reason, don't have the assets to maybe eliminate some debt, we're stuck. But if you have some assets, some reserves, now we can begin to potentially recommend that you pay off a credit card, or recommend that we eliminate this debt, because look, for every $50 in monthly payments, that equals 10,000 in purchase power. So $50 equals 10,000. That means a $500 car payment equals 100,000 in purchase power. So it's really, a lot of folks are like, well, I'll wait till next year when I get that raise. And then you get the raise, but you also get the car. So now we're kind of, just took 2 steps backwards, right? So it's again, budgeting, counseling, go to, talk to your counselors about not only budgeting, but putting together a plan about debt, debt management, because that's really in my opinion, the 2 most important things.
Okay, Alex is dropping gems, y'all. Okay, did you hear? I loved that that way of quantifying, really how your debt affects you in the home buying process. We see this so much in homeownership counseling, right? If you're in our counseling program, you know this. You've met with a counselor, you've done a household budget, and you've done an action plan. And we know that because we do that in the very first session, right? With every single client. And in that plan, very likely your counselor pulled your credit report, at Habitat, and we've helped you determine what are the things that are holding you back, if anything, that it would make sense for you to pay off or pay down to put yourself in a good position to move forward. So critically important. Alex, we had a question just come through from the audience regarding credit score. The question is, what credit score would you say to shoot for if you're looking to get approved for a mortgage?
Well, you should shoot for the loan, shoot for the score that's going to get you approved, right? So obviously, I don't want to tell you, you want to be above 720, right? That's ideal, right? It's gonna open it up and make it so much easier. But if you have a 400 credit score, don't shoot for a 700, right? Shoot for a 580, right? Because again, we talk about loan options. FHA in that situation, you only need a 580 to get in with FHA. So shoot for the score that is obtainable to you that's going to get you into the home, right? So, if you're at a, 400, don't shoot for a 820. Let's get you into the home and then let's shoot for that 820, or just go for the stars, right? It just depends on your goals. But I, since we're talking about home ownership, I always say just shoot for the one that's going to get you into that home.
Yeah, I think that's fantastic. And again, you just don't know, right? Like programs like Habitat, we've got different sorts of underwriting criteria that maybe more traditional lenders have. Each lender is going to have their own criteria based on the products that they offer. At Habitat, we say it's really hard to kind of just with a brush stroke put a credit score out there, to Alex's point. But we would say, if there's kind of a range you want to be in for an ideal position for really being able to competitively shop your options, you really want to look at trying to get to 620 plus. If you can get in that range, you'll hopefully have more than one option and not be just kind of, pigeonholed into, one approval option or something like that.
That's a good point.
Marquita, we see your question. What is an average amount of money to save, assuming that you meet the credit score requirement?
Well, we're going to assume, 3% down payment and 2% closing cost, plus anywhere between 3 to 6 months, I would say, in reserves. That's the you want to have those 3 to 6 months after. Now, again, if we're talking about home ownership, it really depends on everybody's situation, right? If they can afford to save that 5% plus 3 to 6 months in reserves, then do it. If they can't because they got to move out, then let's shoot for that 5% to fix your situation at the moment. So it's kind of like a loaded question, but it's all relative to the person's situation, right?
That's right. And also really relative to the housing market, right? So we would be incredibly remiss if we're here talking about, loan approval and not talking about, the other related conversation to this, which is what the housing market is like right now. So notice to our audience, that Alex is referring to percentages when he talks about how much to save. You never heard Alex say $10,000, $15,000, $20,000, right? Because it depends on the price of the house that you're looking to purchase. And anyone who's interested in homeownership right now, I know for certain knows that this is a crazy hot housing market. It is not a buyer's market, to say the least. And so therefore, if you're looking at, let's just run some, hypothetical numbers. Let's say that you're looking at a home, Marquita, to your question about, $250,000. And right now, we will say, our experience at Habitat tells us that you'd be hard pressed to find something in that range. It's out there, but it's hard, okay? But let's use that as an example, $250,000 sales price. If you're talking about the 5% between your down payment of 3%, and closing costs of 2% that Alex mentioned, that right there alone is $12,500, okay? Not including reserves, not including, any additional earnest money, all the additional fees that you may have to pay, appraisal, stuff that we referred to earlier in the presentation, right? Not to mention just, all of the costs that go into moving, right? Moving expenses and these sorts of things. So that's why, putting pen to paper on some of these numbers, again, saving, so important. Oh, and we have a note from one of our counselors in here that wants to remind everyone, so important, tax season is coming. Tax season is coming. And before we say, hey, $8,000 refund, where did it go? And we hear, I paid off my car, I did X, Y, Z, I went shopping. Excuse me. Remember, home ownership, this is a great opportunity.
Well, and one thing I did want to add was that the information that you're being provided tonight, it's kind of like the non-Kool-Aid version of it. It's kind of like just lemonade without sugar, right? And what I mean by that is, yes, you're gonna hear, well, you don't need that much money to buy a home. Well, no, the lender can help you with your closing costs. Yes, that does exist, right? That does exist. But remember, you're putting yourself in a specific situation where your loan can only close if you receive that assistance, right? And if something happens where that assistance or that lender credit is no longer available, then now you can't close. So the information that you're being provided tonight is to put yourself in a situation where you'll close regardless of all of this other stuff, whether it's grants, whether it's assistance, whether it's that, right? All that stuff, it's great if you get it, but the information being provided is you'll close with or without it, right? So it's a little bit different of a mindset. Just wanted to clarify that.
I think it's awesome. That's awesome. I think we've got to all the questions, if I'm not mistaken. I know we're just a few minutes over, so we will wrap it up. Alex, it has been such a pleasure hosting you tonight. Thank you so much for being here and for everything that you taught us.
No problem, guys, and good luck to everybody, and good luck.